Good evening, everyone. Let me check if everything goes well. Yeah. It seems like, every platform is good. And we shall start on today's sections. Or maybe we should wait for a little bit because this is the first time that that we shift to 7 p.m. for the streaming. So yeah, so let's wait for a little bit. Some of you might be on the way back home and just finish your work. So I'm not even sure that is 7 p.m. a good timing or not. So let's try this out and then you can see the result of how many of you is able to come on 7 p.m. or shall we just shift to 8 p.m. or 9 p.m. for you all, you know? So for this month, I think every stream will be on 7 p.m. to 8:30 for the practical class. And for those like technical analysis and for those like the hot topic discussions, the reasons discussions, those might be on 9 to 10. Yeah, should be on something like that. So just check if you okay with this timing or not. So if this timing is not really a good timing for you, you might comment down below, then we will just adjust it accordingly, maybe, next month onwards. And before we start, this is my personal contact and you can contact me, but I'll be more frequently using the WeCom. And if you want to add me in WeCom, then you can use the WeChat to do so. And this one will be the Telegram contact. And we shall start our sessions on, I would say 3 minutes later. And today we'll be talking about the option seller class. And then actually this one is the secret weapon that used by Warren Buffett. So after this class, actually you already mastered the basic theory of how to become the next Warren Buffett instead. But of course, it's not that simple because there's still you will still need to know a little bit more about the fundamental analysis to become a complete versions of the Warren Buffett strategy. So this is more like a tools for Warren Buffett to get in and get out. Meanwhile, he can use it to earn some extra money from the market. So Warren Buffett actually is using options, and but his majority is using it as a tool to get in and get out. Meanwhile, he can just earn some premium from the market. Aside from just normal buy low sell high, using the options as a tool to just replace the traditional buy low sell high instead. And for those that have missed the class on technical analysis, you can just download the USmart Hong Kong app because there's a recording down there, and then you can check the technical analysis class recording on there. Else, you can just approach to your managers, and then you can just ask for the YouTube channel link because we will put the recording there also. So if you have no idea how to contact your personal managers, this is the way to contact it. So if you download your USmart apps and then you go to the last tab, the last icon here, and then you can just saw a tab that is calling manager. So you tap on the manager tab and then you will see the way to contact your personal managers. And then you can just get whatever information that you want from her or him, including the YouTube link that can just access to all the previous recording. But not all actually, because we are not actually sharing every recording in the YouTube channel. But we will do keep on repeat to just teach you guys about the practical class because we want you to just take your first step to the option market or even the share market or CFD whatsoever, just to take the first step to your investment path. And hopefully we can make some money altogether. And today class, we will be doing it in a way that more toward to practicals. So we will be including the part where we can just place the order instead. But yeah, be careful, yeah, because today is a day off for US market. So yeah, maybe you can just do it slowly instead because we are not rushing for the market to open. Okay, so let's start on today's sections. Let me to get back on the first one. And before we start, let me just give a little bit introduction of my own to you guys. My name is Hu Jun Lo, and I'm a Usmart trainer from Malaysia. And I'll be teaching you guys about all the financial knowledge, including options, technical analysis, fundamental analysis, and the other little hints or the little tools to be used when you want to do a financial analysis. Okay, and then let's start on today's topic. And then today's topic will be option seller. And in the last week, we have already talked about the becoming an options buyer. So in this week, we are going to talk about how to become an option seller and what is the pro and cons of becoming an option seller comparing to becoming a buyer instead. And personally, I think that option seller will be more stable when it comes to P&L, the profit and losses. And this will be the topic for today, the beginner's breakthrough. And we are going to use the options as a seller to just replace the traditional trading method, buy low, sell high way. But we are not going to use it by the normal entry, but we are going to replace it with option selling instead. And this is also the most powerful secret weapon used by Warren Buffett. You can check it on Google and whatsoever. You can see that he used option selling in the Coca-Cola case, and then he do make a tons of money from option selling. And this is the disclaimer for our class. And in our class, we will have the section that we're going to select the stock from the market. We are going to do a little bit of analysis, but there is not a sell call or a buy call. There is not a trade signal that's provided by us. It's just for illustration purposes, and it's just for your better understanding. So this is the disclaimer. And this is the process that we'll go through by today. And now is the opening stage. And later on, we will go to the theory explanations, and we will rest for a little bit. And then if you have any question regarding the theory part, you can just ask. And then afterward, we will go to the real stock pick and operations. But in today, the market is closed. So we might just screening through some stock and hopefully to just using today's strategy on those stock. And then we'll have the Q&A at last. So if you guys have no problem, then we'll just start on the theory explanation first. So if you are a total beginner, please bear with us throughout the whole theory explanation sections. Or if you are an expert already, then you might just bear with us. Maybe you can see a different angle, see from a different angle and understand the options in a different way. And let's talk about what is option, because I think many of you didn't know about what is option. And before we go into the option selling, we might need to think about what is option first. We want to discuss about what is option. So this will be a very lengthy sections, and I hope I can explain it in very detailed manners so that every one of you can just understand from A to Z. Options are the contract that grant you the right, but not the obligations to buy and sell an asset at a specific price on or before a specific date. This is the technical explanation, but we are not going to understand it just by purely the sentence. I'm going to provide you some examples so that you can understand the options in by comparing to a real life example. So options to me is just like placing and booking when you want to purchase a property. As simple as that. So let's say that you want to purchase a property. Let's directly go to the example instead. So let's say there's actually two types of options, which is the call options and the put options. And first of all, we are going to talk about the call options. So the call, when we are talking about the call options, you can think it in this way. We are referring to this case. If you are the buyer of the call options, then let's refer to this example, which we will be referring the options as a property. And then you as a buyer actually have the rights to buy a house from the seller at an agreed price. Let's say 700,000. And then the seller will have the obligations to sell the house to the buyer at an agreed price. And that agreed price will be the same as the buyer one. So the buyer and the seller will come to an agreement, and then the buyer need to place a booking fee to just make this make this contract work. And then this contract is called options. And then in this case, when it is a call options, why the buyer want to do it that way? Because the buyer actually afraid that that property will go up in value in future. So let's say I'm the buyer right now and I'm interested in buying this property, but I have no money right now and I want to just secure the property for a certain period of time. And then this is what I do. I will just place a booking fee to the seller, and then we will just have the agreed price written in the contract. So if in the future that property will go up to 1 million, 2 million or whatsoever, I can still buy it from the seller with the agreed price because I'm utilizing the contract. So this is what I do when it comes to call options. So as the buyer, actually you have the rights to buy a house from the seller at the agreed price, but you pay for the rights. So when you come to the contract, you have everything written in the contract. So the buyer need to pay a certain fee to the seller to just make this contract executed. So in the future, if the property value really goes up to like 1 million, 2 million, or even higher, then I as a buyer are able to just exercise my right as a buyer to buy the house from the seller with 700,000 only. And the seller need to sell me no matter what, because I as a buyer have the right to exercise and the seller only have the obligations to fulfill their duties. So the seller doesn't have the choice whether they want to execute or not. The seller only have the obligations to exercise, to just sell it to me. So when I'm having this kind of contract, what I'm thinking is I'm actually paying a booking fees to book the value to buy in the future. So in the future, if the property value really goes up, then I can just using this contract to buy at a lower price. But what if the price, the value of the property doesn't go up in the future? Let's say the property of the value drop to 500,000 or 400,000 in the future. Then I am the buyer. I don't need to exercise this contract. I'll just leave it gone, leave it expired. So I don't exercise at all, and the fees that I pay as a booking fee will be just gone, burn at all. So this is the case of a call options if you're referring to buying a property. So here comes to the right and the obligations. Do bear with us, yeah, because when it comes to explanation, it will be very lengthened. But believe me, in the second part of the sessions, we are going to talk about the practical way to how to just utilize it, and then hopefully to make you the other Warren Buffett. Okay? Or you can just make a consistent gain from the market instead. So you as the buyer, actually the call buyer has the right to buy, and and the call seller has the obligation to sell. And we already talked about there will be two types of option, right? The call option and also the put options. Now look at the put options. So this is the scenario if you're referring to a property selling. So in this case, I'm not a buyer, but I am the property owner. So I want to buy and to form this contract is because I'm afraid that in the future, my property value is going to drop heavily, like a falling knife. So I do make a contract with the other party, in this case, which is the developer. The developer offer me a bet to just secure my property value. So if my property value drop to a certain level, the developer will just buy it from me. So right now, I am the property owner and I have the right to sell a house to the developer at the agreed price. So this one is actually to secure the minimum value of my property. So the developer have the obligations to buy the house from the owner at the agreed price. So let's say for now, my property actually worth like $1 million. So I'm afraid that in the future it will drop to 500, 400 and even lower. So I come to this contract, I come to approach to this developer, and then we sign on a contract that to ensure that the minimum selling price that I will get is 700,000. So I, as the property owner, have the right to sell a house to the developer at the agreed price. And the developer had the obligations to just buy the house from me at the agreed price when I want to exercise. So in this case, if the property value goes up in the future, so I don't need to exercise it and selling it in 700,000. I can sell it in even more. If the market rate is right now is 1.3 million, 1.5 million, then I can just earn a little bit more from the market instead. I don't need to exercise the contract. But if the property value goes down, I will exercise this contract to ensure that the minimum selling price that I will get is at 700,000. So this is the case if we're referring to a property selling. So you can see in two of these cases, the buyer is actually having the right to buy and sell. So the buyer is actually having the right to execute the options, to execute the contract, while the seller has the obligations to buy and sell from the buyer. So, but there's pro and cons, because if you are the buyer, when you come to form this kind of contract with the seller, you will need to pay a certain fee. So for the first case, I placed the booking fee, and the other case I'm paying like some kind of the insurance fees instead. So to ensure that the minimum selling price that I will get. So as the seller, actually I do receive the cash upfront because they need to pay me a fee so that I can just form a contract with the buyer. And but I have no choice when it comes to execution. I only have the obligations to exercise, obligations to do my duties when it comes to exercise. Okay, so this is the main difference in between a buyer and a seller. And in today's case, we were talking about the seller case. Today, we'll be focusing on becoming the seller instead. So what is an option seller? The seller is actually the one who fulfills the promise. So the pros is actually to get the pay upfront. So when you are the option seller, at the second that you place the order, you just sell the options, you will get paid immediately. And then the con is you will need more money reserved or you will need more asset required. Why? Because for the first case, when we're referring to the let's say the call options, in this case, I as a seller, I will need at least 700,000 to ensure that at the time the buyer want to exercise, I am able to pay this kind of obligation to sell the house. Oh no. So when it comes to call options, I as a seller actually need to ensure that I have the property on hand. So in this case, I will need to have the asset on hand. Meanwhile, the buyer don't need to have any asset on hand. The buyer only need to pay a fee upfront, whereby I as the seller need to have the house on hand to just ensure that when it comes to exercise, I have the house to sell to the buyer. And when it comes to this one, the put options, I, as a seller, in this case, which is the developer, I need to ensure that I have the cash reserve, which is a 700,000. So when the time the owner want to sell, I'm able to just pay this 700,000 to the owner. So if you are the option seller, you will need to have more money reserved for the put options, and you will need to have the asset required for the call options. So how does it reflect on options instead? Let's see on how does it reflect on options. Yeah, so just a little bit heads up. So in next week, I will think in next morning, Monday, next Monday on 9 p.m., I will have a technical analysis class. And if you do join for my this week, if you do join for this week technical analysis class, and then it will be like a more like a in detail class, advanced class for next Monday, 9 to 10 p.m. And for next Thursday, the class will be talking about the vertical spread. And the vertical spread is actually a very good strategy to be used when it comes to options tradings. So if you are a total beginner, and we do offer the I would say options trading recommendation in Usmart, so you can just do it according to the option recommendation. But yeah, do your own due diligence before you doing so. And then we will talk about how do you just check on all of these, and how do you just apply that into the real life situations, and how do you just make all those options recommendation into real money. Okay, let's get back on this. How does it reflect on options? So for call options, this is how you see as a call options. There will be the asset, ABC in this case, which is the quote for the stock. And then you have the expiration date. In this case, 2024, 12/30. And this is the case that we have been using since, let me check that. We will share the recordings. Is there any recording that we can access later? Yes, actually you can just access to the recording in the Hong Kong apps, or you can just get it from the YouTube. We do have a YouTube channel, and then we will share all the recording there. Not all the recordings, but some of those. And I'm not sure which one of those are going to be shown on the YouTube channel. So it will be best case if you don't skip any classes. Okay. So let's get back on this. So in the call options, you actually have the asset name, the quote, and in this case, which is ABC, and this contract is going to expire on 2024, 12/30. And the strike price is 105. And this is a call options due to the last term C. And then you can actually see the stock price right now is at $100. And the premium is $2. And if you are the buyer for the call options, you have the right to buy 100 share of ABC before the expiration date at the strike price. So at this moment, when you want to form a contract, or you want to buy options, the option seller has the obligation to sell 100 shares of ABC when exercised at 105. And this is how you understand it. Why is it 100 share? It's because one option is equivalent to 100 share. So one option is actually having a control on 100 share. That is where the leverage comes from. And when it comes to the options, when the buyer want to buy the options, you want to pay a $200 because this is the premium is $2 per share and you are paying for 100 share. That's why you pay a $200. And I, as a seller, I will get the 200 immediately when this contract is signed. This option is bought or sold. Okay, so you can see that a buyer actually has the right to buy and the seller actually has the obligations to sell. And you can see that the buyer need to pay a fees while the seller will get a premium. And when the buyer will exercise, it's very simple because the buyer has the right to buy it, isn't it? So the strike price is 105. So whenever the price is higher than 105 in the future, the buyer can just exercise the call options and then to buy at 105 from the seller because he can buy at a lower price from the seller and then he can just sell immediately to the market to earn the $5 difference. And when it comes to the seller case, if it rises to 105 and 5 and above, then the buyer will exercise right because you want to buy at a lower price. So the seller need to sell the 100 share no matter what. So this is the pro and cons, and this is how you understand it. So if it rises to 105, it must be sold for that 100 share. So what about a put options? So if you come to a put options, the terms is actually very similar. It's just that the last term is P instead of C. C stands for call options, while the P is stand for put options. Just try to get to understand this kind of concept, and then we will get into the strategy later on, and then we will go into the real life example. So you can see the asset here is ABC and with the same expiration date, and the strike price is different, it's 95 in this time. And then the premium is $2 and the share price is 100. So the buyer actually has the right to sell 100 share of ABC before the expiration date at the strike price. The strike price is the price that we agreed previously. And the seller has the obligation to buy 100 share when exercised. So at the time that the buyer want to buy these options, you need to pay 200. It's because one option is actually equal to 100 share. So a $2 premium per share, it will cost you 200. Whereby the seller get the 200 upfront. And you can see that no matter in the call options or a put options, the seller will get the premium upfront, whereby the buyer need to sell the option, need to pay a certain fee. In this case, which is the 200. So if you are a seller, you are actually keep on getting paid instead. So when do we exercise this kind of thing? The buyer will only exercise when it drop below 95 because the buyer, if you're referring to the property case, the buyer is the property owner, right? So he can just sell at a higher price instead. So if it drop below 95, the buyer can exercise the right to sell 100 share. So you can see that when the market is currently placing on $90, the buyer can actually sell on 95. So it makes $5 more when comparing to selling to the market. If the buyer sell to the market, he only can get $90 per share. But if the buyer exercise these options, he can get $95 per share from the seller. So if drop to 95, you must buy as a seller. So as simple as that. If you understand it from this kind of way, If drop to 95, you must buy, whereby the current market price is 100, right? So if you are a trader before, this is, you can just, you will feel that this is very similar to a buy limit. So what is buy limit? Buy limit is you place the order down here. When it fall below, you will get into the positions. So selling a put is actually similar to placing a buy limit. You can see that if drop to 95, you must buy. So if it drop to, is equivalent to placing a buy limit at 95, whereby the buy limit when you're placing a buy limit, you are unable to get a premium. But in this case, if you are using an options, you are able to get the premium upfront, whereby when it drops to the price that you desire, you can get into position. So this is how we utilize it. So if this one is equivalent to a buy limit, you can actually see that you can actually see that this one is actually very similar to a take profit order. So what is a take profit order? A take profit order is right now the market price is on $100 and you're placing it at a higher level to just exit your position instead. So if instead of placing a selling limit here, you can actually sell a call whereby when you hit the target price that you desire, you can sold your position on hand and you are able to get a premium upfront. So you can see that a seller for a call options is actually a TP order, a sell limit order, whereby a seller for a put options is actually equivalent to a buy limit order. So when it comes to this, you can just understand it from like this way. If you are going to become a seller for a put options, whereby it is very similar to a buy limit order. So if it drop to a 95, you must buy. So you get a premium upfront, and this is actually equivalent to buy low. Right now, the ABC is placing on $100. So when you are doing a seller for put options, you are actually doing a buying low of actions. And then once you're able to get you're able to buy from the buyer, you can actually do another way to sell high. So sell to as a seller for the call options, if it raised to 105, it must be sold. So right now the ABC is placing on $100. So when it dropped to 95, you are able to get into positions. And then when it raised to 105, you are able to exit your position. So that will become a buy low and a sell high. And in two of these cases, you are able to get a premium upfront also. So this is how we utilize the options as a seller to replace the traditional buy low, sell high. When it comes to the traditional buy low, sell high in the market, you actually doesn't get anything from the market, you're only getting the stock only. So by using it as an option seller, you're able to get a premium upfront. So you can earn some, extra money from the market. And this extra money is actually a very powerful returns if you are using it in this way. So here becomes a wheel strategy. This is what we call a wheel strategy, and this is also the strategy used by Warren Buffett. This is the secret weapons used by Warren Buffett. Warren Buffett is well known for the fundamental analysis, right? So he just holding it for a very long period of time until he think that it's overvalued, then he will just sell. So the buy and the sell, actually Warren Buffett is using the options to do so. He's not directly buying the stock. He is using options to get into the positions and get out of the positions of the stock. So this is how he do it. When he buying low, he actually doing a put selling. And then once the price drop to the desired price, the put will get exercised and he will get into the positions. He will buy 100 share of the underlying assets. And then he will just going to place a call selling. So when he sell a call, he will just waiting the price to hit that strike price to exit the 100 share. And meanwhile, he can just keep on making this kind of premium from the market. And this is also what we call a cash secure put and a cover call. Why do we call it this way? It's because when you are doing it a sell put way, you actually need the money to ensure that you're able to buy 100 share. So this is what we call a cash secure put. You need to have the money to ensure that you are able to buy 100 share of the underlying assets. And then a cover call is when you are doing a sell call, you need to ensure that you have the 100 share of assets that is able to sell when it is exercised. So you need to have 100 share of the underlying asset. When you have the underlying assets, then it is called a cover call. And if you don't have the underlying asset and don't have the money to buy 100 share, that is what we call a naked short position. And a naked short position is very dangerous and it will get you liquidated if you don't have the money or the asset to ensure that at the time of exercising, you are able to fulfill your duties. So do not do a naked positions because it is very dangerous and it will block your account and will make you into liquidations instead. So let's see on this case. In this case, I'm using the gold as an example. First of all, we are going to do a buy low, right? And then we are going to do a cash secure put, which is a put selling. So in this case, I'm identifying the level of support that is possible for my entry. So let's say that this is two of the most recent support that I'm able to get. So I will just check on the premium that is able to pay me, because in this way, I'm actually getting the premium when I get into the position and get out of the position. So right now, what I do is I need to ensure that I have the money to buy 100 share of this gold ETF, no matter on this price or a lower support. And let's check on the option premium that is able to get. And in this case, I'm actually selecting these options at the time of my screenshots. So you can see the expiration here is actually 2025, and then it's January 17th. And there's still 29 days until expiration. The number in the bracket is actually the day until expiration. So you can see that I actually captured this during September, the 1st of September, the 1st of December. So I'm actually capturing this on the 1st of December. And you can see that when we are checking the support, the most recent support is 236 and also 229. So let's check on the premium that is able to pay on these two pricing. And you can see that the premium is 2.33 and also 0.97. This is the premium. And you need to understand that if you check on if you're referring back to the chart, you can see that in this support, if I'm going to sell a put options, I'm able to get this kind of money per share. So I'm able to get $233. And then if I'm going to sell the options for this level, I'm only able to get 97 cents per share. So it will make me $97 because one option is equivalent to 100 share. Okay, so let's see if we want to buy from the most recent level. And there's 29 days until the expiration. And you can see that how we are doing it. when I do a cash secure put where I'm selling the put options at 239 strike price, I'm able to get a net premium of 233. It's because one option is actually equivalent to 100 share. So if this is not exercised, I get the premium net and then I didn't get into any position because it doesn't drop below and I'm not able to buy 100 share at this level. So if it did drop below the 236, it dropped below this level, I will get exercise and I'm able to buy 100 share instead. So in this case, if I get exercise, I get the premium upfront and I'm able to buy 100 share. And then what happened is, after I have the share on hand, I'm able to sell high because I successfully buy low. See, I successfully buy low. When I'm selling this put option, I get 233. And when it drop below, I get into this position. If it doesn't drop below, I can just keep on selling the same put option. And then until one day it get exercised and I'm able to get into these positions. So after I get into this position, I only do the sell high. In this case, which is the cover call, which I have 100 share and then I sell a call options. So let's see on if I'm going to sell high as this reasons less resistant, which is 251, I would say. What is the premium that is able to pay me? Is 82 cents. So let's say I sell this cover call, I do this cover call and I'm able to get a net premium of $82 and the net total earnings is $312. And then in this case, the 100 share on my hand are not successfully get filled and not able to sell high, but I'm able to get these two premium from option selling. And I successfully buy low and I didn't successful to get fill and sell high. In this case, I can just keep on selling the same call options until one day it hit 251, then I'm able to sell high. And then this is actually a good news whereby it doesn't hit because I can keep on selling the keep on selling the call options whereby I can keep on collecting this $82 until one day. Let's say that I do this for 5 times. So I collect 5 times of $82, which make it like $410. So I make a 410 before I sell high. That 410 is what we call the premium. It's what we call the extra money from the market. So actually we are using the option selling to replace, whereby we ensure that we can get the premium upfront. So when you're comparing to a normal buy low sell high, you just buy low at 36 and then you sell at 251 and then you the profit they're able to gain is just the difference in the pricing, whereby if you are doing it with options, you are able to get a premium too. So let's say it do goes up and your call options get exercised, you're successful to sell high. So when you're successful to sell high, you can see the total earnings here is different. So because you buy 100 share, right? And then the 100 share is making like $15 per share. And then you'll make an additional capital gain of 1,500. And you can see that actually the premium do take a large of portions when comparing to the total earnings. So actually this premium is just this example because in the normal circumstances, it doesn't really get exercised that easily. So you might do a buy low here for 3 to 4 times until you get filled, and then this 233 will just keep on repeating and repeating and get into your pocket, you know. So this is actually just illustration for one-time trading. So this is what we call a view strategy. We're replacing the buy low and sell high, whereby we're able to get this extra earning from getting the premium from the market. So if you are a traditional US share buyers, a traditional US share traders and investor, you can actually consider to use the options as a seller to replace the way that you do it, the way that you do your tradings. So in that way, even though it didn't get filled or you get filled, you doesn't have any downside. If you get filled, you get into the position. If it doesn't get filled, that premium alone is an extra bonus for you, you know. So this is also what they're called like a free dividend from the market. And if you're comparing it that way, that actually a way lot when comparing to the dividend instead. So the buy low is actually you doing a cash secure put. And if the option is not exercised, you just keep on selling and earn the premium. In that case is this 233. You just keep on selling and keep on earning the 233 until it get exercised and you successfully to buy a 100 share at low. And then after that, you make sure that you have a 100 share on hand, you're able to do a sell high, which is a cover call. So you sell a call with a 100 share, and then if the option is not exercised, you just keep on selling and earning the premium. In that case, is this $82. So you just keep on doing it and keep on collecting this $82 until one day it get exercised and you're able to get the capital gain by selling high. So this is what we call a view strategy. So here come to the live practice sections. Do you guys need a little bit rest? Let me check on, is there any conversations on two of these stream resources? Okay. So let's go on a live practice sections by how to utilizing it to make some earnings. So let's say, okay. Personally, I'm a big fan of gold. So let us do it on gold instead, okay? It looks nice. I do make some money this recently by using the technical analysis that I have been teaching you guys on Tuesday. So if you guys are not aware of the methods, how to build your own technical analysis system, you can just check back on that, or you can just wait for maybe next month I will do a Mandarin sections. I'm not sure. I need to arrange with the others. So let's say about this one. It seems like buying low here and selling high here is a good choice. It's like floating here and it make a fake break here and it come back and retest and then keep on going higher. So I think if we do come back here and do some liquidity sweep or just testing back on these supports, and this might be a very good support to get in, and then this might be a very good resistance to get up, or you can just do a little bit higher here to make this kind of gain. Okay, so let's say that we are doing it in the most simple way, which is this and this. And then let us compare on how to use the option to buy low and sell high. So before you do that, you actually need to ensure that you have the money cash secure put. So we buy low first. Buy low is also equivalent to a cash secure put. Let's say this is the first step. Buy low. Okay. So let me buy low at here. So I do a cash secure put. How will we just let me see on the price. Is 239. So let's say that we are doing it for the options expiring on 1 month. What is the price again? I already forgot it. 239. Okay. 239. Here you go. So first of all, we do a sell put, which is a cash secure put. And let me check on the most recent pricing on this. So the premium you can see is actually 1.39. So it's 1.39. And there's actually something else that you can check. Like example, the trading volume, because when you want to just do the trade, you want to make sure that you get in and get out with no problem. So you can actually use this the volume to ensure that you get in and get out without any problem. It's weird. I thought that my camera is dead. Oh, now I see that. Actually, this is the camera that is reflecting my face. Oh, I keep on facing the wrong camera all the time. It's okay. It's feel a little bit embarrassing. Okay, 1.39. Let me change the camera angle for a bit. Okay, give me some time. Aha! Here it comes. A higher resolutions. Yeah, I keep on facing the same wrong camera. Oh, sorry, my bad. Okay. Hi everyone. Sorry for the little mistake. And let's get back on this. I always thought that I just keep on facing you guys and having this talk all the time, but I found out that I'm facing the wrong camera. Sorry, my bad, my bad. So it's uh 7 February. Let's see on this. This is today, and then let's see on February 7. Yes, here we go. So this is the time where the option is going to expire. And then I'm actually want to buy low here. This is what I do. I make a sell put here. And then my sell put is able to make me $1.39 per share, which will make it 139. This will be the premium that I get when I doing a sell put. Okay, so right now, if it really drop and then it hit this level, if it really drop and hit this level, I am able to get 100 share. If it doesn't, I will just keep this one in my pocket. And then I can just keep on repeating this and then keep on to collect the premium. The number might be different, but it will be around there. So I can just keep on, if it's just floating here and then keep on floating here, I can just keep on collecting this 139. And then after it's expired, I do it one again, and then I collect it one again. Just keep on getting the premium. So after if it really drop below and I'm able to get into the positions, if it really drop below, I'm able to get into the position with 100 share. And then I can do the second step, which is the cover call. And then let's see on what is the price that is able to pay me for doing this cover call. So if I do the sell cover call at 251, okay, 251, I remember the number right now. So 251, you can see here. And the price that I'm able to get, let's check on the rate. The most recent price is $2.19 per share. So it's $2.19, which will make it 219. Okay, so this actually the extra number, the extra benefit that I get from becoming an option seller. If I only do it the normal way where I just do a buy low and sell high, I'm only able to get this gain, the capital gain of the 100 share. So right now, if it really goes up and then you get to exercise, you're able to sold your position at a higher level. If it doesn't, then you can just keep on doing the cover call until one day it hit the target price that you set. So right now you have no share on hand, and then the total number you are able to get is calculator. Only from the premium itself, it will be premium 358, I guess, if I'm not mistaken. Okay. And then what about the capital gain? The capital gain is like 251 deduct 3239, a $12 difference. And then because is for 100 share, because one options is for 100 share, and this is the capital that I get, which is 1,200 capital gain, 1,000, 1200. So the total gain you can see is actually 1,558. So if you are only doing it the normal buy low sell high way, you're only able to get this one. And then this is actually, let's see on the percentage. It's like 29.3%. More. Can see the premium increased by nearly 30%. And this is only if you're doing it one time only. Let's say that it just keep on floating here and there, and then this number is actually can accumulate for a very long time, and then until one day you're able to get exercise, and then you can just gain this capital gain instead. So this is how Warren Buffett is actually doing it. Warren Buffett, when he set a lower price, a fair value price that he desired to get into the position, he just keep on selling the put options here until one day it get hit. So at the multiple time that he doing the put option selling, he actually gain a lot of the premium. And once he get into the position, he just keep on doing the cover call and then keep on collecting the premium until one day it get out of the positions. So you can see that actually these two combined together can become a very powerful weapons to increase your gain by replacing the normal traditional buy low and sell high. So this is how you do it, yeah. And if you are curious about some little hints, I can provide you a little hints. You can actually check on the delta here. Okay, let's see on this one. The sell high, the delta is actually 0.3323. So what does the delta tell you? The delta tell you 0.323. You don't need to understand what is delta, but there's a say that delta is actually equivalent to the percentage that is going up. So when it's floating here, the possibility that is crossing this in this before this expiration date is actually, let me delete somewhere else. Okay. How do you understand delta? Delta is actually meaning that when it's floating here, the probability that it's going to arise before the expiration is around 32%. So in 10 times, you're able to exercise 3 times. So let's say that you are very bad luck people, and then you can just keep on doing the sell high for like 7 times. Then you can get the 219 for extra 7 times before you get out of the positions, you know. So they will make this number even greater when comparing to that. So you can actually utilize the delta to do so. And then make sure that actually you check the trading volume before you get into any position, and you can use the delta just to check on the winning rate. And then this is all about the practical class for today. And I hope that you guys do learn a lot from that. And let me teach you guys a little bit more when it comes to the buying and selling things. Yeah. So when it comes to a sell, when you want to sell high, right? So no, let's get back to the buy low first. Okay. The buy low GLD. What is the price that we want to get in again? Let me check. Yeah. 239. Okay. It's 239, right? So 239. Okay. First of all, we buy low. Is it? So we buy low 239. Change this row number can just make a little bit more expand on that, on the selections of strike price. Okay, 239. Okay, this one. So when you have to buy low, you just click on the sell here and make sure you have the money to buy 100 share at the desired price, which you will need at least 100 times 239. Okay, just to ensure that when you get exercise, you're able to get fill. Okay, so this is how you do trading. There is a limit order and also the market order, whereby the limit order and market order is equivalent to you can set the price that you desire anywhere you like. So let's say that the buy here, you want to do a sell, right? So you need to make sure that you're able to sell at the first priority. So if you want to sell immediately without any worries, you can directly just sell on 1.17. This is actually the highest price that people are willing to buy. So you as a seller, if you want to sell immediately, you actually can just sell at this number. Or you can just and this number is actually equivalent to the price that the seller want to sell. You know, the minimum number that the seller want to sell. So if you want to place before them, you can just using the limit order, and then you can just place the order in between that. I usually do it in this way because I can just make sure that I don't want to get for a too low number. I want to make sure that the premium that I get is a little bit higher when comparing to the price that they're willing to pay. And meanwhile, I want to make sure that I place at the first priority in the seller, right? So when I do a limit order, I just find the number in between and then I place the order. If I am very ambitious and very desire to get into this position instead, I will directly go to the market order. Then it will take this number 1.17. So if you take 1.17, then this number is equivalent to 117 instead of 139. This 139 is because of this is the latest price that they play, and then it will affect the premium that you will get eventually. And that is all for today's sections. At the end, this is the way to contact your manager. If you want to, you can just contact the manager to get into any group that you desire. We do have the community group, and you can contact your manager to just invite you into that group, or for the other questions. Or if you want to contact me, you can just feel free to do so. This is for Telegram and this is for WeChat. And then if you have any question, you can just ask me directly through private message or during the class. And if you have any topic that you want to discuss with, you feel free to contact me. I will check on the message when I'm free. So once again, for next Monday, there will be an advanced technical analysis class. And then for next Thursday, there will be a vertical spread class. And vertical spread is a technique that used in options trading to just make your capital more efficiently. And that is also the strategy that we share a lot in the apps. So you can just check on the options trade recommendations, and then you can just place the trade accordingly. But make sure that you do your due diligence before you placing the order, because that is just a recommendation, but it's not a buy sell call instead. And that's it for today. And if you guys have any questions, feel free to ask. Else, we will just end our session right here. It seems like there is no more questions, and we shall end our sessions right away here. Thank you for your joining, and hope you guys have a nice weekend. Thank you.